Hi everyone, Heinrich here from Lightbulb Wealth Management, and in part two of our Q&A video series, I'd like to bring you some more questions following on from the previous video that we did earlier in the week. So before we jump into that, just a general advice warning that all strategies and information provided in this video are general advice only and does not take into consideration your personal financial objectives, and please arrange an appointment to seek professional financial, legal, credit or taxation advice before acting on any information that may be contained in this video. So let's jump into the next question. This one is a mortgage related question. Heinrich, is now a good time to refinance, and what should we do if we get into difficulty with repayments? So good question. In terms of the first part of that question around refinancing, yes, it's an excellent time to refinance. In fact, it's always a good time to refinance because typically what you will find is when you take out a mortgage over about a 2-year period, you'll find that your rate tends to float out. And by that, what I mean is your rate at the time you take out the loan might be one of the best rates in the market, but generally it becomes more and more uncompetitive as time goes on. So what we typically see is after about 2 years, there are substantially better, more competitive interest rates in the market. So if you've had a mortgage or an investment property loan and you've had it for at least 2 years, then you should definitely be talking to your professional advisor, mortgage broker, and contacting them to review your loan if they haven't already contacted you, because no doubt you'll be able to access a much better interest rate. And so to give you an idea of where interest rates are sitting today, if you've got an owner-occupied loan and you've got a 20% equity position in the property, which means you have a loan-to-value ratio of 80% or less, you're looking at variable rates today with an offset account as low as 2.66%. If you're looking to fix in your loan, say for 2 years, rates as low as 2.09, and a 3-year fixed rate at 2.14. So have a look at your own owner-occupied loan, and if you're paying anything more than that, then you should certainly reach out directly to us at Lightbulb Wealth Management, or talk to your broker or other professional. I've also had a look at investment rates. So if you have a investment property or an investment loan for shares or some other type of investment, today you once again on a loan to value ratio of 80% or under, you can access rates today on an interest only basis as low as 3.33 on average. And if your loan to value ratio is above 80% but below 90, rates on an interest only basis, variable rate loan, 3.59. So these are historically low interest rates. They've never been this low ever in this country. So it's a great time to be looking at refinancing if you're able to. The second part of that question, which is around if you get into difficulty with repayments, what can you do? So there's a few options there. So the first thing you could consider right now under the environment that we're under, banks are pretty accommodative in regards to these things. If you're currently paying principal and interest on your loan, you can switch that to interest only. That's not too difficult to do today. You might want to consider making minimum repayments. So over the last few years, interest rates have come down substantially. You might be in a position where you're actually paying quite a bit more than the minimum, and so you could reduce that, whatever you're paying today, down to the minimum repayment. You just need to call your lender and ask them what the minimum repayment is. And if you're paying more, you could reduce that. For most of our clients, what we see on average is most clients have about 6 months worth of mortgage repayments sitting in a redraw or an offset account. And so if you're in that position, one of the things that you can do is obviously use those funds that are sitting in those facilities to get by the next 6 months or so. And the very last thing that I'd consider doing, and I've left it to last for a reason, is ask the bank to go on a repayment holiday. Effectively, that's a nice term for declaring hardship. And so if you need to do that, then that's what you need to do if you don't have any other options. But it's important to be aware, or certainly have a conversation with your lender, that if you do go on a repayment holiday, if you do declare hardship, they will suspend your mortgage repayments for up to depends on the lender, but up to 6 months. The interest on the loan will be capitalised, so in 6 months' time, when you start making repayments again, you'll be doing it from a higher loan amount, and your repayments will be higher. But importantly, technically, you're going into arrears under this arrangement, and so there is an impact to your credit file and to your credit score. So that's something that you should think about, and just understand that will happen. Have that conversation with your lender, and obviously, if that happens, refinancing any time in the next few years, could be quite problematic, because of how those arrangements typically work with your credit file. So hopefully that helps, that question. The second question, last question for today, and just to keep this video short as possible, the question is, what are some of the things we should be doing with our money to ensure we're in the best possible position when we get through this difficult period? So there's a few things here. Firstly, building up a cash buffer is really important. However, doing that now could be problematic. Obviously, if you've lost your job, you're no longer employed, that strategy is not possible. So this is all about preparation and good financial planning, which is looking at building up a cash buffer and some savings in advance of a crisis or a difficult situation, which we never know when those things are going to happen. So we normally advise clients to have around 6 months to 12 months worth of cash savings if they can, or certainly work towards building that up in an offset account if they have a mortgage, or in some other facility, to be prepared. If you're still working, you still have your job, it's obviously very difficult to know where things will land for you in the next coming period. Then what I'd be doing is certainly trying to build up that cash buffer. Now, one of the ways that you can do that is one of the other points here, which is look at reducing, all discretionary expenses. So if you run a business, look at all of your discretionary spending and start cutting that back where possible. And in terms of household budgets, sitting down and reviewing what you're spending your money on, and where possible, reducing reducing all of your discretionary spending in preparation for the possibility of employment, losing your employment, and by reducing your discretionary spending, you'll be also building up those cash buffers, should you need to access it. The other thing that I'd be doing is looking at reducing any expensive non-deductible debts. So if you have a credit card or a personal loan, look at reducing those expensive non-deductible debts as quickly as possible. Typically, credit cards are running at about a 20% interest rate. Personal loans, variable, but certainly not as expensive as credit cards. So work from the most expensive interest rate you're paying, and work down in terms of priority. That's always a good strategy, no matter what economic situation we find ourselves in. And the second last point that I have is, if you've got an existing portfolio, if you've received professional advice previously, stick to your strategy, stick to the investment strategy, stick to your wealth management plan, and I'd be doubling down on your investments at this point in time. So if you've got the financial means to do so, whether that's making contributions into your superannuation or making contributions into an existing portfolio, I'd be doing that. The caveat there clearly is that, as I said in part 1 of our video series, is making sure you've got an investment grade high quality portfolio. So if you don't own a good quality portfolio, then I certainly wouldn't be contributing to it. I'd be getting professional advice and looking at potentially selling or exiting those investments. So very important to understand what you own, why you own it, and get professional advice. The last point that I have here, and I think it's really, really relevant, it's a very complex area. It's around personal insurances, such as income protection, total permanent disability, insurance, trauma cover, and life cover. It's a very complex area. Certainly don't have enough time to go into it today. But what I would say is that you should absolutely be revisiting your current insurances and having a look at what you have. I'm often surprised when clients come to us for the first time when we look into their insurance position. Most insurances being held within superannuation funds. Many people actually don't even have income protection cover within their super. And so I'd be encouraging you to have a look at what you currently have, how much cover you have, what's the structure of that cover, the terms and conditions, etc. Very important point, a couple of points just to note here about personal insurances is that most people own their insurance cover within their superannuation policy. And so when you go to make a claim, if you're not working, so you need to go make a claim because you've suffered an injury or you have a health-related event, but your premiums are being deducted from super and the policy's owned within your superannuation fund, it could be quite problematic making a claim because a condition of release, if you want to use that term, to get payment is that you need to be employed at the time of making a claim. And so if you've been made redundant, you've lost your employment, and now you suffer, shortly after that redundancy or loss of employment event, now you suffer a health-related event and you need to make a claim. Unbeknownst to you, you're probably not going to be able to access a payment because you're not working. So this is where talking to your financial advisor, if you have one, is extremely important during these periods, because if you believe that you're going to have a change in your personal circumstance, and losing your employment is a substantial change in your personal circumstances, you should be reaching out to your financial advisor and absolutely letting them know about the things that are changing in your life. And so if you are expecting to lose your job or you have lost your job, there are things that can be done to make sure that, should you be in a position where you need to make a claim, that you will get paid. So this is a really, really important point. So reach out to us if you have some questions around this, and we're happy to have a much more in-depth conversation to you about the complexities of insurance, how it works, under what circumstances you will be able to access a claim, and under what circumstances you won't be able to access a claim. And so that's really important. So hopefully that has helped. Two other quick points around that too that I made here was that if you're currently paying your insurance premiums out of your own pocket, so you're not paying it through super, then you can access a 3-month waiver of premium from most insurers and still be covered. The other thing that you might want to consider, this is certainly not something I'm recommending at all, but you could suspend your insurance policy for up to 12 months. But importantly, if you do that, you're not covered for any events. So where that one might be more relevant is if you are planning on taking out the $10,000 from your super this year and maybe $10,000 next year under the government arrangement that they've put in place, then you may decide that it's prudent to stop making the premium repayments. But anyway, for advice, come and have a chat to us, and more than happy to guide you through this. So hopefully that's helped. The video went a little bit longer than expected, but two great questions there. Hopefully that's helped. And if you need any advice, please reach out to us, and you can visit our website at lightbulbwealth.com.au for more information about our products and our services and how we can help you. So stay healthy, stay well, and look forward to speaking to you again soon. Thanks.